Oh my gosh, Clarice, this physical applications class, that's the one I meant. We talked about it. Didn't we talk about it at the club? We did. Is it bad? I'm sorry. Is he at least letting you use your own software?
Can you hear me? I know, this is the problem, right? Yeah. Hi there. Is the sound working? Great. So as many of you already know, the theme for the Michael Davis Lecture Series this year is the financialization of health, which refers to the growth of the financial sector and its increasing entanglement within our health system. It's my privilege to introduce Dr. Victor Roy as this week's speaker. Dr. Roy is currently a VA scholar in the National Clinician Scholars Program at Yale. He completed his residency training in family medicine at Boston University and his medical degree from Northwestern University, as well as his doctorate in sociology from the University of Cambridge. He also co-founded and served as executive director of Globe Med, a network of students on university campuses, and partnered with communities around the world to tackle poverty and health inequality. His new book, Capitalizing a Cure, takes readers into the struggle over a medical breakthrough to investigate the power of finance in business, biomedicine, and public health. I think it's fair to say this book does an exceptional job examining the different dimensions of financialization and how they relate to pharmaceutical strategies and practices as observed in the case of hepatitis C medication. Leveraging a set of analytical tools from political economy, economic sociology, and science and technology studies, Dr. Roy has offered a critical account of the expanding role of the financial sector and what it means for patients, payers, and public health broadly. This book comes at a pivotal moment when the nation is already grappling with how to price drugs and how to curtail years of skyrocketing drug prices, while pharmaceutical companies continue to see huge profit margins and have embedded themselves in governmental policy, health services research, and public health funding. As a sociologist and physician, Dr. Roy is uniquely poised to examine financialization and its implications in our health system. And so with that, I will hand it over to Dr. Roy, and I'm grateful for all of you coming here today.
Well, thank you so much for that introduction. And it's really great to be here and be able to be part of this lecture series on the financialization of health. And so thank you to Joe Brush and Colleen Grogan and Keith Brown and everyone that kind of made this lecture series possible. As Joe mentioned, I'm a physician and a sociologist. And you might be wondering like how I came to this topic of studying finance and financialization. I'll just tell you a brief bit. When I was an undergrad at Northwestern and went to medical school, I was really interested in the HIV/AIDS access movement that really was able to fight for and struggle over access to medicines during the 2000s, both in the US but also internationally. And as I was starting my doctoral work, I was struck by the fact that here we were after all these lessons around pricing, valuation, access to medicines with a new treatment, this time for hepatitis C, with some pretty profound struggles and debates happening around how to price, value, and access these medications. And so it took me far afield from where I thought the study was going to go. I didn't expect to study finance and financialization, but I think that's one of the privileges of doing sociological work where you follow the question, it leads you to this analysis of, or led me to this analysis of finance. And so I'm going to start with a little bit of a historical allusion. Because this is a named lecture series after Michael M. Davis, who was thinking about public finance and the structure and organization of care in the earlier part of the 20th century. Well, at that time, there was an economist, an Austrian economist, not named Hayek, Joseph Schumpeter, who was really interested in thinking about private finance and the way that private finance fueled, in his view, innovation and dynamic change in the economy. And he argued that banks or money markets were the headquarters of capitalism. And in his view, capitalism was a kind of form of economy in which innovation was fueled through borrowed money. Banks would take deposits and make loans, and people could take those loans and pursue new products, services, and markets. Now, fast forward to today, and I would argue, and I'm going to argue, that the financial sector and the way it's organized and its relationship to innovation is very different from the one Joseph Schumpeter was imagining in the first part of the 20th century. He would find what we have today a bit more unfamiliar. And I'm going to make the argument, I think the task before myself that I have in front of you all is to try and connect it to the liver. And that that actually understanding this actually helps us understand whether people have healthy livers or have hepatitis C. So we're going to try and make financialization a little bit more concrete at the level of the liver. So we'll see if I succeed, and you guys can give me feedback at the end. So I'm going to set the scene for the book. Then I'm going to share 3 kind of analytical frames that I think are useful for dissecting financialization when it comes to the pharmaceutical sector and biomedical innovation. But I hope that as you think about your own areas of health and health policy, that you find some links, that the analytical frames might be useful even in other parts of what you're examining. And then we're going to discuss some potential futures of how we might proceed in this time of financialization and what it might mean for innovation, for public health, and what it might mean for all of us. Okay, so that's the plan. I'm going to start the story. It's June of 2015. I'm doing some field work at this clinic in the safety net in South LA. And at this federally qualified health center, they have 70 patients that have hepatitis C that they've diagnosed and would benefit from treatment. And there's a lot of hope in the air because just about 18 months or so before, there was approved at that time a new curative treatment for these patients. But in speaking with the health workers, there was also a lot of frustration and anger because so far, to that point, they'd only been able to get one person on the treatment. And to explain kind of the controversy, I need to take you into hepatitis C a little bit, give you a little bit of background, and then we'll be able to kind of describe what the main controversy was. So what is hepatitis C? It's a deadly virus that injures the liver. It's transmitted primarily via the blood. Injecting drug use currently is the leading way of transmitting it. And in the time before we did screening of blood transfusions was another way. And so this really does impact structurally marginalized populations. So people that inject drugs, those that are in the incarcerated, and this comes into play later on in the story. It injures the liver over time, potentially leading to cirrhosis, so a distortion of the liver tissue, end-stage liver disease. It can lead to liver cancer and death. And it can be a very ugly death, right? Where you don't know who you are because of the way it alters your mental status. You can bleed and have a really distended belly. It's a really kind of gruesome end for those that have end-stage liver disease. And the older treatments for these patients were really toxic. You needed to take weekly injectable treatments using something called interferon. And you'd need to take this treatment for a year, and you weren't necessarily guaranteed that you'd get better. The cure rates were far lower than 50% in a lot of the patient populations in studies. And it's a disease that affects a lot of people in the US, over 2 million, and globally, from 2016 data, about 70 million, according to the WHO. So along comes these sofosbuvir-based medicines. That's the main compound, sofosbuvir. They're approved in December of 2013, the first series of them. The manufacturer, Gilead Sciences, then rolls out a series of improvements where this sofosbuvir-based regimen can treat all the different varieties or genotypes of hepatitis C. And the treatments offer cure rates north of 90%, which is really unheard of, right, in contemporary medicine to have such a big medical breakthrough. But the applause for science gets met with contention and consternation because the prices are set north of $90,000. Right? This is a Bloomberg Business Week front cover. It's a treatment that cures the disease after just taking the treatment daily for 3 months. So another beautiful thing. You don't need to take this as a lifelong treatment. 3 months, and you can eliminate the virus. So it becomes dubbed the $1,000 a day pill. And so this, of course, leads to a series of political fights. And state Medicaid agencies, where a lot of patients are covered with hepatitis C, face a struggle, right? With the large patient populations with a high price, of course, they have to make decisions about how much they can use in terms of their funding to cover this drug. And so the state Medicaid state Medicaid agencies decide to ration the treatment, where you have to have advanced liver disease in order to qualify. And even then, in order to qualify, you have to go through a series of lab tests, meet sobriety requirements, kind of punitive requirements to kind of basically control costs for the agencies. And so in the first year, state Medicaid programs spend $1 billion to cover only 2.4% of the population that's on Medicaid. This also catches the eye of the US Senate Committee. Senators Wyden and Grassley, a bipartisan group, end up investigating Gilead Sciences because Medicare, one of the other major public funders of medicines, ends up spending a lot of money to cover patients on this treatment. Something like $13 billion goes towards this one treatment in the year after launch. As this controversy is playing out, what's really grabs my attention is that there's an interesting set of justifications for the pricing. Right, you might have heard typically drug companies make the argument that the prices of their drugs are linked to how much it costs to do research and development. And the idea that because research and development is really costly, companies are able to have monopoly protections through patents to be able to charge high prices to recoup that research and development investment. But there's a different argument that's being made with hepatitis C. And that argument is that because these are curative treatments, they have a huge value to society. They avert liver transplants. They avert hospitalizations. And there's such a big breakthrough compared to the previous treatments that we as a society should be willing to pay for it. So this is the kind of headline we start getting in places like Vox, right? Sarah Cliff, who's done a lot of investigative journalism and now is the New York Times, she talks to a bunch of health economists and comes up with the conclusion that, you know what, this is a good deal based on the fact that this is a curative treatment. Now, this was kind of an interesting puzzle to me because I think the implication here was that our best treatments, our medical breakthroughs, should by definition be the most expensive, right? Because we should be willing to pay more for better health. And I wanted to try and understand where that logic was coming from and what it kind of meant for biomedical innovation and for public health. And what's interesting is that this kind of logic echoed what the pharmaceutical industry was saying, particularly Gilead Sciences, their executive, says, price is the wrong subject. Value should be the discussion, right? Trying to shift our attention to really focus on the fact that these are incredibly valuable treatments. So this is where the analysis of finance and financialization comes in, because I realized the more and more I looked at this, that where some of these debates, how they would be constructed, without an analysis of finance and financialization, it was really hard to unpick what was happening. As you've probably already heard in this lecture series, broadly speaking, financialization is about the rising power of financial sector actors, motives, and logics in our economy and in our society. And for those that might be unacquainted, very briefly, and in a broad way, this does come really out of economic history and sociological literatures. This is Greta Krippner's work as a sociologist describing how in the latter part of the 20th century, really even starting in the post-war era, how the financial sector starts becoming a bigger and bigger part of our economy due to a set of policy decisions made by politicians to give financial markets more power. As we get later into the 20th century, the financial sector accounts for a larger share of overall profits in our economy when you compare it to manufacturing and service sectors. And this kind of growth of the financial sector ends up impacting businesses that aren't even involved directly in financial services. So companies that are typically oriented around, let's say, manufacturing or product development are oriented more and more around financial markets, share prices, trying to gain short-term growth and distributing that growth to shareholders. And this is Gerald Davis's work kind of describing what the implications of this are for the American corporation. Now, You might be wondering what all of this has to do with drug pricing and biomedical innovation. So that's part of the link I try and make in this book, Capitalizing a Cure, is how does financialization shape the way the drugs are made, priced, and valued? Kind of try and open up the black box and make these links. And the way I do this is by really doing a sociological case study of these sofosbuvir-based medicines. And so I can talk more about the methods in the Q&A. I'll just very briefly say that the general approach was a historical one where I traced the process behind the making and developing of these drugs and the policy struggle from the mid-1990s into just a few years ago. The conceptual sources, like Joe already mentioned, I drew on a set of literatures that are kind of adjacent to health policy, but I think are actually useful to lean on in this case to then kind of critically look at what was happening in some of the policy debates. So science and technology studies, political economy, and the economic and medical sociology evaluation. And the empirical and data sources, I triangulated between a bunch of different sources. I'm just gonna name two that I think might be interesting. One are the earnings calls transcripts between firm executives and Wall Street. They're a gold mine because this is how companies are communicating what they believe about themselves currently and in the future directly to Wall Street. There's a lot of information there that I don't think social scientists and health policy researchers take advantage enough of. But that's one source of data. The other one was the US Senate investigation, which happened to come out in like the third year of my PhD with 1,500 pages of internal corporate documents. Which was obviously very useful to understanding some of these dynamics and to really see what was happening on the inside. So I'm gonna try and distill a lot of what I talk about in the book. It's about 140 pages and it's available open access, so I encourage you guys to check it out. What I'm trying to distill, huh? Okay, yeah, you can buy it. It's a paperback. It's like 34 bucks. But you know, I wanted to make this in the spirit of this project, make it openly available, right? I didn't want to monetize it, just to be consistent. But the analytical frames that I use here, one is really focusing on this idea of assets and how knowledge becomes turned into financial assets, tracing that process. Thinking about value, right? And this is a frame value or word that comes up all the time in health policy, but understanding how it gets configured around maximizing shareholder value and what the implications there are. And then as a sociologist, we're interested in power. And here I'm interested not just in like the overt political power of lobbying and money in politics, but the way in which power operates through hegemony. And I'll explain what I mean by the creation of kind of a common sense view that helps this entire financialized process kind of keep going. Okay, so we're now gonna go through each one over the next like 20 or so minutes, okay? So let's start with knowledge and financial assets. So to think a little bit about the concept of assets, first I'm just gonna tell you very briefly what the story is behind how these drugs were made, at least in the early phases. And it's a common story, it's a story that you'll find to be very familiar. Pharmasset is a company that's started by Ray Shinazi. He's a publicly funded scientist at the VA and at Emory down in Atlanta. He's gotten decades of publicly funded research on nucleoside science. And so he's got an idea to start a company that is going to focus on antiviral development based off of this publicly funded science. Pharmasset itself gets 16 grants from the National Institutes of Health in its early goings to kind of help develop their operations and strategy, but they also raise venture capital as they spin out from Emory and the VA, and ultimately become listed on NASDAQ. They use some of that money to ultimately develop this compound called sofosbuvir and enter it into, by the end of this period in 2008, into clinical studies. So I'm gonna fast forward, it's 2011. Pharmasset has spent $271 million on research and development on these drugs. They don't have any products, they don't have any revenues, but they're valued at $8 billion, right? Now, it's an interesting opportunity to understand, if you want to understand financialization, it's helpful to understand where does that $8 billion valuation come from for a company that has no products or revenues and has spent $270 million on R&D. So this is where a concept of assets comes into play. And this process of assetization, right? And this is actually drawing on science and technology studies, drawing on an economist named Thorsten Veblen, who was writing in the early 20th century, analyzing industrial power. And his view was that capital is ultimately the ownership and control over assets in a community. So whoever's able to own and control assets in a community is able to have basically capital and be able to exert power in that economy. And in the case of pharmaceuticals and biomedical innovation, assets don't have to be something that's concrete like a pill. They can be things that are intangible, like knowledge. It could be tangible, right? You can have tangible assets like housing, but you can have intangible assets like knowledge. And the key is, how do you turn the ownership and control over something intangible like knowledge that hasn't been actually used to develop the product yet into a future earnings stream? Right? And that's like really critical to this entire process. And that relies on a whole set of political, legal, and economic processes that turn, in this case, socially produced, publicly funded science, hybrid with private sector involvement, into patents, right? Patents that companies like Pharmasec can monetize, that Wall Street can value. And this really accelerates in the 1980s for rules and legal changes that I describe in the book, where publicly funded science is able to be mobilized into these kinds of asset formations with biotech startups that then also have venture capital backing. Now, just to put a finer point on this idea of assets, assets have different logics actually than what we normally think of in terms of commodities, right? You'll often hear about the commodification of healthcare, and I'd actually argue that we also have the assetization of healthcare, and there's a little bit of a distinction here. Commodities, they get their value from exchange, right? You buy an iTunes track, you pay a little bit of money, you gain access to that commodity. Whereas an asset, the value comes from the ownership over that future earning stream. So that's like the musician's intellectual property over that music that is in that one track, right? And this leads to interesting kind of demand logics and pricing logics, because what happens with commodities is when you have a lot of demand for a commodity, usually that'll draw in additional producers and the prices can go down over time. But with assets, when there's a lot of demand for an asset, because of the ownership and control dynamics, it's made to be artificially scarce, right? And so the demand leads to an increase in the price. Think about housing, right? The more people that want a piece of property, you can actually drive up the price of the house. And so we see assets increasing in their valuation in the context of biotech. And I'm going to explain this in the context of Pharmasec, when there's an idea that this treatment area could be really lucrative. So where does that $8 billion valuation come from? So I'm going to go back to that here with Pharmasec. Now, part of it does come from the fact that there's maturing technology that Pharmasec has. So like I described before, there's important public funding behind the sofosbuvir-based medicines. This is a study that detailed the public funding that went behind these treatments. And this is actually really attractive to venture capitalists, right? So this is one of the venture capitalists that backs Pharmasec. He says, due to NIH funding now also going towards programs that demonstrate commercial potential, our startups are much further along by the time we invest, even though they might be still straight out of academia. And so it's important to know that part of the value creation process does actually start with, in many instances, government money. This is work by Mariana Mazzucato in a book that's become popular since 2013 or 14 in The Entrepreneurial State, in which he describes the ways in which the public sector can oftentimes take on the most uncertain, riskiest stages of an innovation process and actually help draw in private capital subsequent to that initial investment period. Of course, there's another side to where that $8 billion valuation comes from, and that's that the hepatitis C treatments that are already on the market, even though they don't necessarily lead to great treatment outcomes, are already priced north of $50,000, right? So investors know that if another treatment comes out with even better outcomes, society might be able to, or health systems might be willing to pay even more for it. And so this is just a plot from looking at the Swiss market, but actually could very well be the US market. The x-axis looking at cure rates from 0 to 100%, and each bar representing a new generation of treatment since the late 1990s. And what we see here is that for each generation of improvement in therapy, the prices go up. So the launch price for each generation sets the floor for the next set of treatments. And this equates to basically for every 1% increase in the cure rate, we get about $1,000 more in terms of the launch price. And so this kind of anticipation of downstream markets that could be really lucrative helps draw in, it is true, a series of financial actors. It actually does mobilize a group of economic actors, but they have a lot of variety in terms of how involved they are actually in the investment mechanism versus financial actors that might be more involved in trading on the share price of something. So you've got venture capitalists that are taking on a period of investment in return for hopefully an exit that they're able to make a good return on. And then you've got actors like hedge funds who later on in the process are trading on the share price, trying to buy low and sell high. One of the examples of a hedge fund involved in hepatitis C is run by this guy that you might now be familiar with, Vivek Ramaswamy. He makes most of his initial wealth actually in hepatitis C, taking out stakes in companies like Pharmasset. So he's one of the major shareholders in Pharmasset and is able to make hundreds of millions of dollars through his stakes in a series of hepatitis C compounds. And so the main takeaway with this whole idea around assets is that, for financial actors, the focus is really on the exit. None of these actors are involved for the period of time it takes to actually develop a treatment, right? They're involved to the point where they can mitigate their risk and get out for an exit. And Pharmasset, the company's founder, Ray Shanazi, has this idea in his mind as well. He says, I coined the name. It's actually pharmaceutical assets, right? It's right in the name, Pharmasset. And the idea was to create assets that could be sold to companies. That was the initial business plan. So now I'm going to turn to the suitors, right? Who are the companies that are going to buy these assets? And look at the structural dynamics around the big pharmaceutical companies. And this is where we need to understand value and how it's configured around maximizing shareholder value. So let's look at Gilead. It's a really financially successful business by 2011. It's making a lot of money, $8 billion in revenue. It's the main, its main treatment area is HIV. And they've got $10 billion in cash on hand. Their profit margins are handsome, over 30%. Wall Street is kind of worried because their share price is doing this. It's kind of horizontal. There isn't much growth. This is a Bloomberg business commentary looking at Gilead. As its earlier galloping growth begins to slow, investors are starting to wonder what Gilead plans to do for a second act. So Gilead's feeling the heat. How is it going to grow? And to kind of try and understand what position Gilead's in, I'm going to just walk you through how capital kind of flows through these publicly traded companies in a very simplified model, but just to kind of help understand some of the dynamics at play here. So you've got a company like Gilead. They make, in this case, technologies. In this case, HIV is already. They capture a share of the value they create through payments from governments and from households through the insurance premiums we pay. They can reinvest some of that money in research and development, manufacturing, or workers, or they can distribute that capital to shareholders, who are the executives of the company, asset managers, pension funds. I want to key in on this part right here, because there's this idea that has been advanced since the 1970s, 1980s, that really the purpose of the corporation is to maximize the flow of capital to shareholders. And this idea is that corporate shareholders, more than corporate managers, can efficiently allocate that money and capital across the economy, whereas corporate executives might spend it more wastefully. And so the focus of corporations should really be to distribute capital to shareholders and focus on their share price, because this is the way that shareholders can know which are the companies that have the most potential to grow in the future. Because that's what a share price ultimately is. Which companies have the greatest potential for future growth? So it's not just that profits matter, right? It's which companies are going to grow their profits the most. So this is a distinction I like to make. It's not just about profits, it's about growth and profits. And that actually matters a lot when we're talking about research and development. I'm going to get to that. Now, how companies distribute this capital to shareholders? There's one of two major ways. You've got dividends, which probably all are familiar with, where shareholders get some capital for the shares that they own. And then since 1982, when the SEC changed its rules and made this maneuver legal, this thing called a share buyback, where companies can buy their own shares off the stock market. And why do they do this? Well, it reduces the denominator in the earnings per share ratio, right? And that increases that ratio. It makes their stock look more valuable, and it's a way of increasing their share price. And so this is a maneuver. These sets of maneuvers are very much a big part of the pharmaceutical industry strategy. One study looked at the pharmaceutical companies on the S&P 500 in this 2012 to 2021 period, and found that those companies spent $87 billion more on buybacks and dividends than they spent on research and development. So and this is part of why there's an idea by a group of economists that have posited that actually maximizing shareholder value is actually a strategy of value extraction, because it drives executives to pursue short-term profits rather than long-term investments, partly because executive compensation is so much of a big part of executive compensation is share ownership, that actually drives part of that short-term kind of profit motive is about trying to charge high prices that corporations can charge the public through their control in concentrated markets, and that it fundamentally rewards financial actors that don't actually even invest in a company's value creating capabilities, right? A company like Gilead isn't going to Wall Street and saying, hey, we need your capital to build this factory, because they already have retained capital from the sales that they've had on drugs. And so there's, particularly with share buybacks, actually even some bipartisan concern. These are three men that don't agree on much, who have expressed their concerns over share buybacks. And this kind of rose particularly during the pandemic because there was so much government aid flowing to private entities. And there was concern that public money was basically being turned around and being used on share buybacks. So let's come back to the pharmaceutical sector and biomedical innovation. Is shareholder growth compatible with research and development? We know, and the drug companies will tell us, it takes a long time to develop a new treatment. But they also have this imperative to deliver growth in short time horizons. And this is work from Kaushik Sundararajan, who's actually at U of Chicago, is an anthropologist, wrote this terrific book called Pharmacracy, where he analyzes the pharmaceutical sector and looks at kind of the structural positioning of the large publicly traded companies. And he finds that because of this imperative to grow and deliver growth to shareholders at a clip of about 10% every year, against this backdrop of having to take long-term risks in research and development, it's actually disincentivized to actually do that, right? So actually the best way to deliver growth is for big companies to become acquisition specialists, right? And so this is one of the main ways that they can deliver growth to shareholders. And if you look at Gilead Sciences, the way they talk about themselves to Wall Street, and I can walk you through their corporate transactions, this is the way they see themselves. Gilead's CEO saying, we typically like things where we can have an impact on phase 3 and where we can accelerate those products either into the approval process or into greater indications after the approval process. So I'm going to remind you, 2011, Gilead's kind of stagnating in terms of growth, even though their profitability is over 30% in terms of profit rates, margins, and they have about $8 billion in revenue. But the company goes out and buys Pharmasset for $11 billion. Now that valuation, $11 billion, has nothing to do with how much money Pharmasset has spent on research and development, right? $271 million. This has everything to do with what Gilead thinks the hepatitis C market will be in the future. And so I'm going to fast forward. I'm going to get back to the pricing in the third part of the talk, but I'm going to talk a little bit about this company that ends up making $46.4 billion in 3 years off of this one treatment area. And where does this money go? Now, I can go through this plot a little bit here, where the revenues definitely jump. That blue line, a lot of that money goes to cash stockpiles for their future acquisitions. That's the orange line. And the gray line is share buybacks and dividends. Whereas that yellow line at the bottom, that's your R&D. So if you the key takeaway is that the company, after acquiring this hepatitis C drug, they spent $33 billion in terms of shareholder payouts, most of that through buybacks, $26 billion, and they spent $11 billion in R&D. So 3 times as much on shareholder payouts as on R&D. And part of that might be explained by the fact that the corporate managers, the C-suite, are major shareholders in the corporation, right? And so the five executives in Gilead in those 5 years, in those 3 years after the launch period, make over $1 billion, just these 5 individuals: the CEO, the COO, the EVP, the head of R&D, and the CFO, right? And let's just look at how the head of R&D for Gilead talks about the strategy, right? This is the head of R&D we're talking about. And as he's talking to Wall Street, he says, if you look at the last 6 years, it has been remarkable. We have done many, many deals. He names all the acquisitions. And yet we were able to return 70% of our free cash flow to shareholders. So I think this is a good way to think about the future. Now I'm just going to contrast this. It's a very different conception of the role of a pharmaceutical entity than, let's say, a post-war era version of Merck This is a Time cover from 1952. This is George Merck, with the subtitle there being "Medicine is for people, not for profits." But Merck is, at that time, a much more integrated company doing the whole kind of research and development up into manufacturing, right? Whereas I've just contrasted with the kind of conception that Gilead has of itself and the function it plays in the innovation process. And so, I'm going to make the provocative claim here, drawing on Mariana Mazzucato's work here again, that we have made it easier for some to call themselves value creators and in the process extract value. Now, how does this happen? I'm going to make the claim here in this third part that we have to look at power, and power, again, not in the kind of overt political lobbying sense, though that's a really important part of the story, but power in the form of hegemony. And this, I'm going to draw on Kaushik Sundararajan's work in Pharmacracy again, where he draws on this idea from the social theorist Antonio Gramsci, hegemony being kind of the establishment of a new common sense. And what is this common sense? So let's use the pricing debates as part of the story, as the story here. How does Gilead set their price? So this is just directly from their internal corporate documents. They say that they basically bill directly on the current hepatitis C prices, and they put a little value premium, right? Because the treatments are better, they can charge a premium to the public for that. They do know that because there's large numbers of people that can benefit, times multiplied by these high price points, they might face opposition, so they do a heat map. They actually map out the stakeholders, payers to the public in general, and they map out how far up they can go in terms of the upward bounds of prices that they can charge the public. And they basically model out where they might face resistance. They even model out the likelihood of a letter from Congress, a likelihood of a congressional hearing over their pricing of Sofosbuvir. Now they have an interesting, I would argue, set of unwitting, potentially, allies in this. And that is actually in some parts of the health policy community. In that the argument is also being made in the literature, right, that these are really cost-effective treatments. And they are, because of how much of a benefit they're providing society, that even at a high price point, they are deemed in study after study after study to be cost-effective. And so this is kind of the conclusion, right, that the health policy community in many corners are making. I want to paint a monolithic picture, but this is a predominant and prevailing view. The most important thing to remember about cost effectiveness is that something that is really expensive can still be cost effective if it is really, really effective. And these drugs are very, very effective. And this is a position by an expression by Mark Roberts, who's a professor at Pittsburgh. And so I wanted to kind of trace, where does this come from, right? And how do we understand this economic valuation? And so a book that, if you're interested in these topics, I'd recommend you take a look at, by another sociologist, anthropologist, Drugs for Life, by Joseph Dumet, How Pharmaceutical Companies Define Our Health, in which he looks at the post-war era and the emergence of all these kind of epistemic practices that are foundational, bedrock to contemporary biomedicine, right? Long-term clinical studies of natural history, clinical trials, clinical epidemiology, pharmacoeconomic studies, that are really important ways of basically measuring the impact that new therapies can have on not just individuals, but on populations. And he says that this is able to help kind of construct a transformation in the way we think of disease and treatment, not just treating felt illness, right? I'm feeling sick, I'm gonna go and get a drug, but that health systems are gonna be able to use treatment to treat a statistical illness, right? And by being able to treat a population, they can be able to garner some kind of economic value of this kind of future health. Right, in hepatitis C, it's this idea of averted healthcare costs in the future, averted liver transplants, things like that. And these are actually really important practices about how we allocate capital. There's a deep rationality embedded in this that I argue is a really important part of what we do in thinking about how we allocate resources in society. But what I think is actually really interesting is ways in which this gets appropriated by the pharmaceutical sector, in particular Gilead, in this argument, and struggle over Hep C. So kind of walk through this kind of Wall Street corporate academia nexus and the construction of this common sense view. So as the company's facing a lot of resistance, Gilead's executives communicate to Wall Street, we've got all these publications out there, not by Gilead, but by respected people in the field who can start these conversations in a more of an academic, collegial way. And their their R&D executive says, we're putting all of this together into a bigger pharmacoeconomic argument. And so just a few months later in the Harvard Business Review, you have prominent health economists from USC, from Harvard, citing their industry conflicts of interest, making the argument that actually this whole focus on price is just theater, and that society should kind of ignore all this kind of political consternation over pricing and pay up, because this is value for money. And ProPublica later actually does an analysis of how the pharmaceutical industry ends up enlisting a whole group of professors to justify these prices. And so I think it's an interesting kind of case study in the ways in which academia and health policy and the intersections with kind of how financial logics kind of come into health policy debates and then affect public health policy, right? So this is the National Academy of Medicine. We have a group convened to look at the elimination of hepatitis C. And they conclude from a medical perspective, we could eliminate it as a country, but from an economic perspective, the group concludes it would require near universal access to treatment, something that appears unfeasible given the current pricing and policy environment. Right, this is 2016. 7 years later, in 2013, June of 2013, just a few months ago, the CDC puts out this headline. This is still where we're at as a country. Even though the prices have actually come down, and we can talk about that, the breakthrough cures for hepatitis C still fail to reach the vast majority of Americans who need them. Between 2018 and 2020, 15,000 people died of hepatitis C each year, right, from an avoidable cause because we have the curative treatment. Now, I can't say that pricing is the only driver here. There's a couple of other pieces to this puzzle, but it's one of them, particularly for Medicaid and patients that are in state prison systems that can't afford even the lower price of the drug. So what I argue in the book is that value in this case actually becomes untethered from ideas around maximizing access and public health, and it's completely fastened to financial markets and strategies of growth, speculation, and extraction. Now, I'm just gonna put a finer point on it because Gilead actually gets swallowed up in all of this too, right? Because what happens with a curative asset? It's not a lifelong treatment. It can't generate the growth you need. So the company initially, stock price goes up, but as the Wall Street gets a handle on the fact that this won't generate long-term growth because it's not a lifelong treatment, their stock price actually halves, right? Even though they're making profit margins well over 40% and have revenues well over $30 billion. And Goldman Sachs says the quiet part out loud, right? Is curing patients a sustainable business model? Citing Gilead as their case study, right? And this is, I would argue, if you want to understand this headline, you have to understand what I've described up until this point in terms of financialized business model. This kind of concludes the empirical part of the talk. Just to summarize the three analytical frames, and I think that they're applicable to areas not just in biomedical innovation, right? I'd put in knowledge as financial assets. What about healthcare delivery entities as financial assets, right? And ways in which ownership and control operates and the implications of this. Value is talked about in so many parts of health policy, but how is it being actually configured in ways that actually are oriented around maximizing shareholder value, even if that's not made explicit? And then third, this idea of power as kind of hegemony, the ways in which these views become the common sense view in health policy and public health circles in ways that actually makes it really hard to kind of think about creating change. So in this last part of this talk, I'm going to describe a couple potential futures in this time of financialization. We know that launch prices for new treatments have gone up each year since 2008. This was a study from the Portal Group at Harvard looking at the trends from 2008 to 2021. You can see the numbers right there. This is just a headline from Sunday in Bloomberg Business. How is the country going to pay for $1 million cures for gene therapies for sickle cell, for example? And the headline here is, we'll test whether the US healthcare system can afford to deliver miracles for the many and not just the few. And all these dynamics I've just described with hepatitis C, I fear will be replicated with the sickle cell treatments. And there are some that actually argue, to respond to this, we should double down on financialization. So this is a paper in Science in 2016 from a group at MIT that argues one way of doing this is actually creating new financial products, mortgages, to pay for curative treatments. In this case, insurance companies would pay a down payment, and then individual patients would have annual payments with an interest rate of about 9% to add to the list of debts that American households already have. The article does argue, however, to their credit, that a law mandating full coverage for curative therapies, allowing for price negotiation, would likely be more economically efficient, sustainable, and socially more acceptable than a pure private sector solution. And we actually have a great example of this straight from hepatitis C. It's called the VA. The VA system, after an initial period where they struggle in terms of figuring out access, once they figure it out in about 2014, the red line is the curve looking at the number of patients, veterans awaiting treatment, plummets because they're able to diagnose and treat people because they have negotiated prices, universal access, and the VA health system is on a path to eliminate Hep C amongst veterans. And in an equitable way, all the subgroups across veterans have a greater than 80% rate of being treated, right? So this is like health equity in action here in the case of hepatitis C through the VA system. And there's other bright spots. Louisiana, they try something called a Netflix arrangement, where basically the state agrees to give a lump sum payment to the pharmaceutical sector in return for unlimited access to these treatments for a defined period of time. And this is a win-win because the companies get some guaranteed revenue, and it incentivizes the health system to go out and diagnose and treat as many people as possible. And this idea is being talked about, being scaled up at a national level. So Francis Collins has proposed this. This is a piece in JAMA, to create a federal Netflix program that would basically procure these drugs for all the state Medicaid programs, state prison systems, Indian health services, all the systems that don't have the money to pay for these drugs at their current prices. So we'll see where this goes. And there are bigger ideas outside of hepatitis C, but just how we think about the public sector in the innovation process altogether, and whether we should be thinking about more public options, right, around research and development and even manufacturing. So this is a paper, this is a white paper by the Democracy Collaborative that analyzes the public options that the public sector can take in R&D. And so this, there's discussion around this new agency in the federal government that Biden has started called ARPA-H, Advanced Research Projects Agencies for Health, whether this could be an agency that is involved in the late stages of innovation, and when they are, actually set fair pricing and access provisions when they work with the public sector. Operation Warp Speed is an example of the government actually being really involved in the late stages of research and development and helping develop the COVID vaccines. And then in California, Governor Newsom has put $150 million behind creating a public manufacturing strategy around insulin, partnering with a nonprofit group, Civica RX, to try and see if the state can bring down the price and cost of the overall health system as well as individuals in the case of insulin. So I'm just gonna come back to where I started and hepatitis C. These ideas that I just talked about, they're important so that we don't keep on repeating what happened with hep C, right? Where there's a curative treatment, patients are waiting, and in the clinic, this is just what the health workers had to create. There were all these Post-its, right, up on the clinic walls, trying to figure out how to work through all the paperwork to try and get even those patients with advanced stages of hep C access to the medicines. And I think part of this work is just to argue that we shouldn't take this as the status quo, as just the taken for granted natural way that we do biomedical innovation and access to medicines. That part of the work has to be to denaturalize this, to defamiliarize ourselves of this kind of phenomenon, and to have a kind of imagination about how things could work otherwise. So I'll just end with a little bit of an inspiring quote from an author, Ursula Le Guin. The exercise of imagination is dangerous to those who profit from the way things are because it has the power to show the way things are is not permanent, not universal, and not necessary. Thank you so much. So I'm happy to have, hopefully that provoked a lot of thoughts. And I'm happy to kind of have a conversation and back and forth.
Yeah, so in a second, I'll open this up to questions, but I just want to commend Victor on really a stunning analysis on an area of scholarly research that has really not garnered the critical attention it deserves. So I'm super grateful for this work, and yeah, I'd be eager to hear what people think and the questions they have.
Maybe some, yeah.
This is a question, although it may sound like a rhetorical question. I honestly don't understand why people are bothered by the stock buyout thing. I understand if insiders are buying the stock, there's a
Yeah.
question of whether they may be getting other shareholders to overpay if they have inside information or whatever. But why are people so concerned about stock buybacks? It just seems to me like we have a capital market, and we have shareholders who want to sell shares, and we have other people who think the shares are worth a lot. I don't quite understand why there's such a public outcry over that particular mechanism.
Yeah.
And what it demonstrates.
I think it's a good question. So I think that there's kind of two ways at looking at kind of share buybacks. I think one, there's actually just a fundamental framing question, right? That if corporations on the one hand are actually telling the public that we need to charge high prices because it costs a lot of money to do business, but on the other hand, they're actually saying we don't have uses of this capital and we're going to just drive this into share buybacks. There's actually fundamental, I think, tension and contradiction between those two arguments. And so it's not so much the argument is here, let's stop share buybacks. It's the fact that these companies have this amount of capital, right, to work with, indicates that maybe actually more systems in which we have more competition, price regulations, regulating some of these companies as public utilities wouldn't be actually a bad thing. And that all this money is being driven into share buybacks is less about kind of analyzing the share buybacks itself and tells us a little bit more about like where the market dynamics are and how companies are able to derive that amount of capital in the first place. There is a second point in that this does drive the incentives of the key actors in the firm, right? The executives. And so if your major part of your compensation packages are in stock compensation, then you're going to pursue strategies that can maximize the amount of capital you have to engage in share buybacks. So I think it's less about kind of trying to regulate share buybacks, but more what it tells us about the overall ecosystem and the arguments that are being made. Yeah.
Who can do things to manipulate the stock price. But that's not really about pharmaceutical companies. That's really just about how do we properly regulate the capital market so that people with inside corporate power can't in some way leverage those improperly. I'm just puzzled by it.
Victor, fantastic talk. Can you explain a little bit about how the maximizing shareholder value causes these executives to behave and price differently than just monopoly pricing? They have a patent, they can monopoly price. How are they behaving differently because of the financialization than just like the classic monopoly pricing of a firm?
So I think I think that's a great question. So I think the thing is that they're intertwined. And part of what's happening here is that over time, the strategies of the big publicly traded companies in this scenario of maximizing shareholder value, I think the key insight there is like the way that they become more oriented around acquisitions, right? And so how do you engage in acquisitions? That's driven primarily by driving huge cash stockpiles, right? That they can accumulate over time. So part of the idea here is that you use monopoly pricing to then generate major cash reserves that can be used to kind of drive a cycle of acquisitions and buybacks, right? Those are like the two major allocations of capital that these firm executives are kind of driven towards. And how this implicates price, like how does that influence like the actual prices? I think that's where you have to bring in the analysis of really it is about how the prices increase over time, right? And so these companies, it stacks it, right, over time. And so that's where you have companies that if you look at their cash reserves, 20 years ago, and this is an empirical question, but I'm going to hypothesize that the cash reserves were actually much smaller than they are now, where you have companies like Gilead at that time, I think had over $30 billion in just cash, right? And that's primarily driven by the fact that like Wall Street expected them, they couldn't, even if they wanted to, price it at like $30,000 because Wall Street was already anticipating that the price of the existing treatments are $70,000, $80,000. And so you have to, the idea is like the whole chain of speculative capital is, well, you're going to be able to make a little bit more if you come up with a better treatment.
So you're saying that like for Hep C drugs, they deviated from profit maximizing monopoly pricing because of this history of stacking. Like they might have made more money in the short term had they charged a lower price because of just the standard relationships between what Medicaid could afford to pay and the number of people that it could cover, right? Or do you think they extracted like maximum monopoly profits from the Hep C drugs, or
I
not?
think that, so it's a complicated story that is kind of hard to unpick because the company anticipated that they only had about like 1 or 2 years before other actors would kind of enter the market. So they knew that in those 2 years, they kind of had, or in that period of time, they had kind of maximal control over the Hep C market. So in that time was the time where they could go as high as they could. And they tried to model out kind of what the upward limits are, right? That's part of the heat map I showed. And they assume that if they went any further, they'd even face even more consternation. So it's a and then yeah, so it's a bit of a complicated story, but that's kind of what the calculation was in that time period. That's a good question.
Going back to the first question, I guess maybe another way of framing it is if you feel that there's a different rule book for healthcare or pharmaceutical than there are in other capitalist industries. I think, just, I mean, as a physician, like this, the idea, and we talked about this a little bit, like the capitalism being applied to healthcare, which is supposed to be about altruistic, saving patients' lives. It's a different sort of field, at least we view it that way within medicine, but it's certainly profitable for companies. So I guess like, how do you, is it maybe more about like rule book and how we look at what should be governing their practices?
Yeah, so I think one way, and this kind of, let me try and like go back to Harold Pollack's question about the share buybacks, and your question about the value. I think part of this is really a debate about who creates value and how and where that value goes, right? And also who takes risks, and how we allocate the rewards. And in healthcare and in health, a lot of the risk is borne by the public. If you look at research and development in biomedical research, if you look in the healthcare delivery, right, who covers low-income patients? Who covers elderly people that are more sick and are going to be harder to cover otherwise on insurance, right? It's public programs. And so I think, to your point, part of these things exist because we view health to be, in at least some places, a common good or a public good. And so then I think that in this kind of environment, when the public is so involved in trying to deliver that good, then it should invite certain kinds of questions about, do we have the relationship between the public and the private set up in the right way? Do we have risks and rewards shared and distributed in the right way? And I think that's what this book is trying to get at, is like, I think it's out of balance, because if we think it's in balance, then like what we've just described, it should be just like how we do it, right? Like this is the best we can do. And breakthrough treatments, we have breakthroughs, but really follow through can take 10 or 15 years, and people that are low income on publicly funded programs, they'll get the treatment when they can get it, right? And like that's kind of the kind of deeper question here, is like, in a public-private system that we have in the US, is the partnership between the public and the private parasitic, or is it symbiotic? And so I think we can have that debate, but I think those are the kinds of questions we need to be asking.
So I think you made kind of a provocative analysis where you talk about power and hegemony, and you've kind of shined the spotlight back on us and the scholarly community, and particularly the health policy community, and the way that certain individuals or areas within health policy, the epistemic authority that they've gained has kind of informed the logic of what is value and how we should price our drugs. And I'm wondering from you, like, for those of us who are concerned about that logic within the health policy community, how do we start to untether that logic? How do we start to like question the underlying logics, and like what do we do to start complicating our certainly our complicity, or our complicit nature within this issue, but also how do we get to the futures you're talking about?
Yeah, it's a great question. I'd say there's a bunch of different strategies. One is, I do think that there are kind of solutions that are on the margins, or might be on the margins of academia, some of the ones I just described. But actually, I think it's important to study those and try and figure out what empirical methods we can use to study some of the alternative mechanisms that are proposed, alternative models. I think that brings in fresh debates into the sphere. I think in terms of trying to diagnose and analyze the problem, I'd love to think about like how what kind of different research methods could be used. I use very non-traditional methods where I coded like earnings calls transcripts, right? Like they were much more informative to me than the interviews that I did with some of the insiders, because they're just saying all the things out loud, and it helps you understand actually what logic is at play here, rather than like kind of some answer you might get from an interview. And I think that, so we need to think about what are different research methodologies that can kind of get at some of these questions of political economy, the institutional dynamics, the historical dynamics, so that we don't start the conversation taking all the kind of existing dynamics of health policy as just a given. I think that's where we end up with a narrow discussion, because we assume all these kind of variables as taken for granted and as givens. And I think we can use some creative methods to empirically look at ways in which some of those assumptions could be unsettled. And I think I'm not sure if the NIH will fund that, but there are other funders, and I think other groups that are interested, particularly because people are trying to have some kind of like new economic thinking around some of these issues to kind of come up with some different ways at these questions and problems. I don't know if that answers your question, but yeah.
Hi, thank you for a great talk. So I'm curious in terms of thinking about policy and solutions, how the Inflation Reduction Act and like the Medicare drug price negotiations could possibly be part of a solution, and also with Medicaid being also, a mix of federal and state funding, how, thinking about policy where people who on Medicare maybe have access to a medication, but people on Medicaid are being denied the same medication, and just thinking about, policy in that regard and how that interacts with this conversation.
Yeah, I think what I'd say is that obviously what I've just brought up, there isn't like one magic bullet solution. There's like a whole set of policy options that are going to be applied and used for different treatment areas, therapies, because it depends on, is this a rare disease? Are we talking about large patient populations? There'll be different policy options for each of those things. I think the Inflation Reduction Act and what you're referring to with the introduction of drug pricing negotiation after a long period of struggle in US health policy circles to actually finally have that, even in a limited way, will be a really interesting kind of experiment to see how that actually goes. And it'll be with a limited set of treatments initially. I think the challenge is how do you actually move it? Right now, those negotiations can only start many years into after the drug has been launched. And I think part of the question is, can we learn enough from that experiment to then at some point be able to argue, especially for the treatments that have huge public health importance, to bring that up right into the negotiation process when they launch, right? Rather than just assume that it's going to be 7 years or 8 years until the public will be able to afford this treatment. I think those are, bigger policy questions that are, going to take years and decades, maybe, well, hopefully not decades, but, are going to be part of the political struggle. I think Medicaid is also obviously, a different beast in terms of how to think about that, because we've got, 50 states with 50 Medicaid programs, and with very fragmented negotiating power. And so that's why I think this Netflix model is interesting with the Hep C. Like, can they actually do this where they kind of basically aggregate the negotiating power of all states and their Medicaid programs to say, we as the federal government can do something that you as an individual state can't do. I think that's why I think I'm watching this Hep C closely. Unfortunately, because of the political gridlock, we don't see movement on this, but at least as an idea that it's on the agenda, I think is promising, because maybe that could be one approach with some of these more breakthrough treatments.
Hey, Victor, good to see you.
Yeah.
I have two questions for you. One related to your last answer and sort of the end of the talk, and a second one related to the heat map. My first question is about like the futures in the gene therapies and the sickle cell disease that you mentioned. And my sense is that that's going to be far more expensive than Savasivir was, which was like, what, 84,000? And this will be probably add 2 zeros at the end of that.
Yep.
And my sense is like, what lessons do you think we can learn from Savasivir that can be applied to the far more expensive cases? Do you think that there are pair models that are like in place or could be put in place, like Netflix or other things that could be done? And then also sort of on the business side, like, do you think that the scale is going to change some of those conversations? Do you think you'll see those types of headlines that the Goldman Sachs people had? And then I guess my second question is on the heat map side. Like you had mentioned that they had like mapped out the possibility that like Congress would be called in. And then like notoriously Congress was called in for Savasivir and they wrote an 80+ page report about Savasivir and how bad it was and how it's a case study.
Yeah.
And like, do you think that the companies have a sense of the public relations piece of it, if even anticipatorily they like thought that Congress might be called in and they were completely wrong? So I guess just to summarize, one about sort of the gene therapies and cost, and second about sort of the public relations aspect of things.
Yeah. So the gene therapies, I think, are, yeah, as you say, are going to make Hep C look quaint, right? Like that was $90,000. We're talking about 2 million with what we're going to see with like the sickle cell treatments. It is a smaller group of patients, but still a much higher number per treatment. And so I've got like, these are extra slides that I've got up, but I think that the lessons, unfortunately, are, I think what we're going to see is like a way in which how, unfortunately, with the sickle cell treatments, I think we're going to see race play, a really problematic role in that the pharmaceutical sector is already trying to figure out how they can actually use an anti-racist frame to argue that actually, if we value Black health and Black life, then we should pay this much money for those treatments. And they've kind of, these are just some like examples where Vertex has given money to Ibram Kendi, and kind of like the framing around this, which is, going to be really an interesting argument. And actually there are parallels with what happened in Hep C, which is that a lot of the folks were like, if you don't pay for this, then you're stigmatizing this structurally marginalized patient population, which is a really interesting kind of framework to kind of crack. And I think in terms of, the headlines, I think we're going to see headlines around sickle cell. We already are. And once they come out, particularly with Medicaid programs. And I think there's been discussion around like outcome-based agreements, right? Where, companies, basically there'll be kind of like a bit of a pay for performance kind of agreements, but we know that those are really actually hard to enact in practice, and clawing back money, for example, if the treatments don't work. But I'm not an expert on those kinds of agreements. I think the Netflix agreement would seem to be something like that would also be really interesting to try out. But we'll kind of see where the policy discussion goes on that. I think we at least do have the Hep C example to like quick, if you want to get a case study, I would encourage people to read the book, because basically a lot of those things, I think you can probably replace the price and the treatment, and a lot of the dynamics will probably be pretty similar. So hopefully, we can advance the policy conversation pretty quickly. And then in terms of the public relations piece, Hep C is an interesting example because I think the companies did anticipate some blowback, and particularly Gilead. Part of the challenge was that there were so many patients that they didn't anticipate would actually want the treatment right away, because they were kind of warehoused, as it was being called, right? Because these were patients waiting for these treatments. And so as soon as this treatment came out, there was a large number of patients that could benefit. And so the costs were so high that it did kind of create this sticker shock. And I think this is something that they underestimated. But at this point, I think this is part of where it's going to be interesting to see in the ways in which I think, arguments around value. I think the reason that the companies now don't want to talk about R&D costs, because there's no relationship, right? Like Gilead spent, they made $46 billion. I guess they would argue that they spent $11 billion to buy the drug, but that's not an R&D cost, right? That's the cost of circulating finance capital through the process. And so that's why this value argument is going to be really powerful, I think, and what they're going to lean on to really kind of drive in these PR battles. And I think part of it is going to be about bringing in the key kind of academic voices to help them make those arguments.
Yeah, let me just bring in a couple of questions from people on Zoom. So one question was about whether the Netflix approach, whether it applies to only states' Medicaid programs, or should we be viewing this as like all for all payers? And then the other question How do you think about incentives for firms to develop curative treatments? Is there a relationship to financialization um, and the development of more curative treatments?
Yeah, those are both really good questions. So the all-payer Netflix model, the idea for the Netflix model comes from a country that actually did it exactly that way, right? Like in Australia, they did a federal program where they basically are like, we're not going to let you guys enter our markets unless we strike a deal. So Australia is where we see this first kind of really take place, where they had about, I don't remember exactly the dollar figure, but a small amount of, small meaning like $1 billion or something like this for hepatitis C. And they went to the companies and struck a deal for a Netflix model, and it actually put the country on path to elimination. And so, I think that's just like much harder in the US system because we have so many fragmented actors and vested interests. And so, to try and get all pairs on that train is going to be a huge challenge. But I think, that should be part of the policy conversation. Because that would be even more powerful for the kind of our breakthrough treatments. Now the question of incentives, I think around curative treatments, it is really hard. I think the reason that these treatments were developed in part was because there was such a huge patient population, right? That like they did make a lot of money. So there was like a huge financial incentive in that way. But again, like the argument that then Gilead actually used that money to kind of drive towards cures for, let's say, HIV, if anything, it actually taught Gilead, and you can actually read the earnings calls transcripts, to tell Wall Street, like, look, we've got these HIV treatments. Guess what? They're lifelong treatments. And it's like where we're going to base our growth off of, right? Look at PrEP. We're kind of trying to get people on PrEP. All these treatments, these are lifelong treatments. This is where we're going to get growth from. And so it didn't actually necessarily incentivize, so to that question, I think it's a really challenging one. And I think it depends on the treatment we're looking at. I think I didn't answer I think this goes to Fraser, your question also around curative treatments. Like, I think it depends on the patient the size of the patient population that could benefit, the length of treatment that would be entailed in that given area. I think the idea that people have talked about for a long time is this delinkage model, right? Where the public offers prizes. And this has been in the policy conversation for a long time, where the government basically delinks the R&D market from the pricing and delivery market, where they go to a company and say, we'll give you $10 billion if you develop this drug, and then we're going to license it to to a generic manufacturer, for example, or to a manufacturer that will manufacture this at the cost, near the cost of production. That would be like kind of the easiest way theoretically to incentivize cures, where the public says there's a big public interest, we will allocate amount of money, we will give you a prize, and then we can then make it widely available at the cost of production. And I don't know if I mentioned this, like in this case in Hep C, the drugs only cost $100 to manufacture, right? They're priced at $90,000, but they cost about $100 in the factory to make.
Yeah, thank you so much for this insightful talk, Dr. Roy. I guess I'll just come out and say my question's about single payer. And I'm just wondering, like I think we've talked about some of these other possible options and ways that people are approaching this, like the Netflix model and things like that, but they're very like, fragmentary approaches. They might work in some places, not others. They benefit some people and not others. And so just thinking like, from a medical perspective, if our goal is to get people the treatments that are indicated, when they need them rather than delaying until they have end-stage liver disease, et cetera, how do you think like, a single payer model where you have this much stronger negotiating power on the side of, the payer, given that you said, like Medicaid is fragmented and like, thus less people are covered, like how would coverage and treatment of things like looking into the future, like these sickle cell treatments and then Hep C patients now, how might that look in a single payer model? And what are other possible, like, I don't know, side effects or unintended consequences that you might foresee?
Yeah, so I think from the Hep C example, we saw what happened with single payer across Europe, right? So what happened there, just kind of, and I'm not putting up the empirical evidence, it's in the book because I do cover some of what happens internationally in chapter 3. But what happens in those systems is that there are delays in terms of access of months to sometimes a small number of years, because that period of time, the single payer systems are negotiating with the industry. Like that's what that time goes to. unlike in the US where like the treatments were available, but only to a fraction of the population, in the single payer systems, the access opened up a little bit later, but to a much larger, like, to most of the patient population pretty quickly. And so I think that's kind of one, we just have case studies of what happened during Hep C. And then, same thing with the Australia example, right? They were able to use their negotiating, like what we know of monopsony, right? The power of a single purchaser, not just a single producer, monopsony power of the government to be able to then negotiate prices in a way that, is more favorable in terms of access. I think, of course, there are huge political, fights around that, because there will be the argument that we can talk about around, how does this change the incentives for doing R&D?
Yeah, so thank you for this talk. I had a question on the research and development for drugs with, or diseases with very low patient populations. So is the actual money that's spent towards the research and development proportional to like the graph that you showed us earlier, where like a lot of it, 3 times the money was spent on shareholder value and like only a small portion was spent on research and development? So like for gene therapies, when they say that research and development costs are much higher, is more of that going towards shareholder value, or is it proportional to like how many people
It's
are
an
paid?
interesting question in terms of, I'd have to actually like empirically look at that in a way that was systematic that I didn't in this study. I think that because of the smaller patient numbers, there's the idea, the premise that you can, charge higher prices because that's the only way to kind of circulate the capital in a way that people will want to invest. And so I think that that's definitely a piece of this. And when there are smaller numbers, I think payers can deal with that a little bit easier, though I'm sure other people would maybe have counterpoints to that claim that I just made. I think it becomes much harder when there are multiple rare disease treatments, like might exist in 10 years that are all like $3, $4, $5, $6 million. And then the population of rare diseases ends up being actually like not so rare because of, in aggregate, it's actually quite a bit of money. So, I think that in this case, that is all about like, how do we circulate that those prices? The premise behind the prices, like what I've described, is like, how do you circulate enough capital to kind of like finance, especially rare disease areas? Whether like companies that are doing this disproportionately spend their money on shareholder payouts versus R&D, I would venture a guess that the patterns are pretty similar, but that's an empirical question that I would need to take a closer look at.
So we're about at time, but I again want to thank you so much for this really exciting and fascinating talk. And this will be one of many talks on the financialization of health for this year. So I invite you to come, and I appreciate everyone who came here today. Thanks.